Good morning, traders. This is your Forex market commentary brought to you by ECN. Today's discussion, we're going to explore the implication of yesterday's BOE inflation report and how it has impacted market sentiment towards the British pound moving forward. If you have been trading the pound over the past 6 months, you would be aware that the sterling has been one of the best performing currency against the greenback, and this is largely due to interest rate expectation. So first in line, we're going to explore the technical front on the pound sterling market. Pound sterling rallied 90 pips, shy of the 1.6600 level on the Bank of England governor's remark that the UK interest rate would have to rise, maybe not at the immediate moment, but eventually it will have to rise. This remark significantly underlined yesterday's bullish momentum during the release of the Bank of England inflation report. Now, the pending question is that whether this momentum can carry forward and sustain this breakout. The contrarian view to this pound rally can be observed on the SSI ratio, which is a speculative sentiment index, showed that the retail traders are sitting on their most net sterling short positions. Could this be suggestive of a potential pound top on the technical front? Bank of England governor tried to cool the market aggressive pound euphoria by altering its forward guidance. Since unemployment rate is close to being met, the bank reiterated to the market that it will use other leading economic indicators such as wage growth, productivity report, and business confidence as a gauge for rate hike decisions. So looking at this chart closely, an analysis of a collection of technical indicators on the hourly interval on the pound dollar market suggests a temporary bullish market sentiment and recommends short positions on the greenback. The hourly chart established short-term Fibonacci resistance at 1.6604 and Fibonacci support at 1.6584. Yesterday's pound dollar market rally verified a strong bullish uptrend when mapped on the Bollinger Band. The new highs seen during the intraday trading session exceed the upper Bollinger Band numerous times, which is a quality of a bullish bias. Since the beginning of this week trading session, pound sterling continued to trade above the 200-day simple moving average for the first time in a week. This price discovery allowed investors to revise their long-term bullish outlook on the pound if it continued to trade above the 200-day simple moving average. This trend action holds great significance as 200-day simple moving average contains more or less of 1 year's worth of trading data. This bullish market sentiment is validated by the pound dollar pair, opening today's Sydney trading session above the 5, 10, and 20 simple moving average, but below the 30-day simple moving average, which collectively overall is indicative of a buy recommendation on the technical front. So let's move down to this chart. This chart is the pound dollar market on a daily scale over a period of 6 months. So what we can see here, it is important to note that over the past 6 months that the greenback had been relatively strong against its counterpart, such as the Australian dollar, the Japanese yen, and the euro. However, except for the pound, and this is largely due to sterling bullish bias, which have been riding on interest rate expectation. Bank of England forward guidance are being met, so market are pricing in the interest rate expectation. However, if BOE failed to hike rate in mid or late 2014, what you can see here is a drop or possible correction if the Bank of England disappoint the market expectation. After all, with any currency trading, it is all about expectation and how does economic indicators and how does central bank meet market expectation. And this is what underscored the rally of the pound over the past 6 months. Coming down here, we have the U.S. non-farm payroll. This is really important because the recent dollar correction during Janet Yellen testimony is largely attributed to whether the Fed is hindering on tapering or not. Of course, having a look at this since October, the non-farm payroll has met and exceeded forecast, except from December to January, which had fallen below forecast. This is very concerning as tapering was instigated based on the concept that the U.S. recovery is gaining traction. However, since the December non-farm payroll fell below expectation, and Yellen did make it clear during her testimony to Congress that she's paying close attention to the jobless number moving forward and how that will affect her planned action in tapering. Okay, looking at this chart, looking at the next chart, we have the Bank of England forward guidance weighted against the UK LIBOR rate. Remember, the UK LIBOR rate is the intrabank lending rate, so you can't really see really well. In the grey bar, the UK LIBOR rate, the 3 months LIBOR rate, has been increasing significantly because it's measured a small margin against unemployment rate. It shows very little change, but you have to take my word for it. It has been increasing significantly. Also part of the Bank of England forward guidance is the unemployment rate, which has been dropping from the mid 7% to the near 7% target. What is concerning right now is the CPI number, which had peaked in August and September at 2% and now is sitting around 1.7 and 1.8. So what does this tell us? This graph here tells us that one component of the Bank of England forward guidance, which is unemployment rate, is close to being met. However, CPI is far cry from that 2% target that the Bank of England is looking for. But yet the LIBOR rate is showing that the market are already pricing a rate hike through the rising in interbank lending rate. So now let's focus on the fundamental fronts on the British pound. First of all, we're going to break down yesterday's BOE inflation report. So breaking down the inflation report delivered yesterday during the BOE meeting, the market long-term bullish view on the pound has been validated by an optimistic tone set by the Bank of England. Being the envy of the OECD bloc, the UK growth story had been relatively robust with no deflationary concern that its European or Japanese counterpart has to address. Ultimately, this leads the Bank of England down the path of monetary normalization as interest rate expectation is running high. Both the Bank of England Governor Mark Carney and the Monetary Policy Committee strongly reiterate to the market that the UK benchmark rate will remain low, but the bank has upgraded its economic forecast with an optimistic undertone, expecting the UK GDP to grow by 3.4%, up from a prior forecast of a 2.8% and a 2.7% for 2015, revised from a 2.3% prior forecast. It is also important to note that the UK quarterly inflation report hold great significance on the pound fundamentals as it weighs heavily on the Bank of England forward guidance policy. The bank forward guidance policy state that the interest rate discussion will not happen until unemployment rate hits 7% threshold, and the bank does not expect the target to be met until 2015. However, currently the Bank of the UK unemployment rate is sitting at 7.1%. Nevertheless, this event showed that the market has overpriced the pound sterling based on forward guidance, despite the Bank of England consistently reassured the market that it will not act on unemployment rate alone. Two scenarios can potentially play out moving forward. One is that the market can admit defeat for aggressively building up the bullish pound momentum riding on interest rate expectation over the past 6 months, which could significantly lead to a significant correction in the British pound dollar market. Or the second scenario is that the Bank of England has to give away and hike rate in line with market expectation before its target date of 2015. Analysts are valuing the probability that the Bank of England will eventually change its forward guidance and eventually hike rate in 2014 at 40%. At the same time, analysts are also pricing in the probability that the Bank of England can shift its emphasis on unemployment rate to CPI number and hike rate later on in 2015 instead at 50%. Over across the Atlantic in America, Janet Yellen's testimony to the House of Congress in Washington, D.C. was an eventful risk to the market on the greenback front. Yellen reiterated to the market that she is committed to the continuity in the tapering program set by the previous Federal Reserve Chairman, and this confirmation is the type of validation that falls in line with market expectation. However, the market is becoming more and more desensitized to tapering announcement. This could largely be attributed to the fact that the Fed had yet to announce an outright withdrawal of stimulus program altogether. Yellen admitted to the Financial Service Committee that she was taken back by the disappointing U.S. non-farm payroll and made it clear that the tapering program do not follow a preset course. Therefore, it is subjected to economic climate at the time. She is also flexible with the option of stalling tapering if in the case that, quote, we have longer period of disappointing data and market turbulence, unquote. The Federal Reserve balance sheet is now currently sitting at $4.1 trillion. So to conclude this commentary, I want to thank everybody for listening and have a successful trade.